It looks like the Atlanta Fed has just confirmed that we are in a technical recession by confirming negative growth for Q2. And now the question is, where do we go from here? That's what we're going to cover in this video. So guys, smash that like button, subscribe if you're new. You're watching More Money. Let's get it. What's up guys, and welcome back to the channel where the goal here is to help at least 1,000 people achieve financial independence much sooner. And let's dive right into it. So you can see here, the Atlanta Fed slashed the Q2 GDP forecast to 0, confirming a technical recession. And effectively what this does is, because we have backwards in Q1, if we're going backwards 2 quarters in a row, that is the confirmation of a recession. And when I read the headlines, it actually said that they were forecasting a negative 1% growth in Q2. However, over the long weekend, when I sort of confirmed it, you can see that the number actually went lower than 1%. So you can see here that when I looked into it, the story actually got worse because the latest estimate as of July 1st is a negative 2.1% growth in the second quarter. So the GDP Now model estimates for real GDP growth, which is a seasonally adjusted annual rate in the second quarter of 2022, is negative 2.1% on July 1st, down from 1% as of June 30th. Now, the only thing that I do want to point out to you is that adjustments are made to get the official forecast, or could potentially be made to get to the official forecast. So this is not an official prediction. And you can see here that in the fine print, although the news articles are reporting this, none of them are really saying that this is not an official forecast, albeit it probably could be looked at as an official forecast, but it technically is not. So GDP Now is not an official forecast of the Atlanta Fed. Rather, it's best viewed as a running estimate of the real GDP growth based on available economic data for the current measured quarter. So take that with a grain of salt. The Atlanta Fed has not confirmed that that is their accurate estimate for Q2 yet. And what you see here is these are the economic projections of the Federal Reserve based on their last meeting in June of 2022. And I think what we could have on our hands is inflation while the economy is in a technical recession. So you can see that the core inflation number is expected to be 4.3%. And I believe that that change in real GDP overall could turn negative or get very close to 0. So now you have an economy running at close to 0 or even running backwards, and inflation continue to run hot, and inflation could continue to run hot. So we'll see how this whole thing plays out, but it's not looking good. And of course, you can see that this, of course, is why we have seen continued pressure on the stock market. But my question is, has it been overdone for at least some companies? So effectively, has the baby been thrown out with the bathwater in some situations? Well, you can see here, this is the tracker that the Patreons get access to. I believe that there's 10 names that are trading under 50% of their intrinsic value. You can see that I've highlighted 2 of them. One of them is Alibaba. You guys all are well aware of that story. Alibaba's trading at 39% of its intrinsic value, even though it's come up from $80 just a month or 2 ago to close to $120 per share now. The second name is Best Buy. Best Buy just snuck under that 50% of their intrinsic value as of last week. I understand that there's short-term pressures for Best Buy with a consumer-led slowdown, but perpetually, is this company worth $67 per share? I don't think so. I love their CEO, by the way. Best Buy CEO is my favorite CEO in America. Okay, now moving on, if you go a little bit lower, you notice that there's 20 names trading between 50 and 75% of their intrinsic value. And you can see that I've shown a couple of them. So you can see that there's Zillow Group there. It's highlighted green because I believe that Zillow is an exceptional company and a best of breed. And so that's trading at approximately 55% of its intrinsic value. And a big part of that is because of the softness in the housing market. And you're seeing that they had weak Q1 results. So forecast that out for the remainder of 2022. You are going to see weak results in 2022 and potentially 2023. But is the company perpetually worth $34 per share? I don't think so. Alphabet, another name that has been coming down. Now, they're going to do that stock split, so I think that that'll bring the price up a little bit. But I do believe that Alphabet is trading at approximately 56% of its intrinsic value. And this is a company that's firing on all cylinders. YouTube is growing, search is still growing a little bit, and the cloud is coming in really strong. And so it's very hard to not want to own Alphabet. And I do believe that before the end of the year, Alphabet will be one of the bigger positions in my portfolio. And then moving on, you can see that HP It's trading at approximately 60% of its intrinsic value. This is a name that Warren Buffett recently bought. Meta, I've talked a lot about Meta. It's trading at around 62% of its intrinsic value. I think there's a couple of catalysts that can take the share price from 160 back to that $200 per share level. But I also believe that there could potentially be some near-term headwinds that could bring the share price lower than $150 per share. I will be waiting with a buy order if that share price goes under $150 per share. Dave & Buster's, nobody likes this name except for me. I love this company, but I do want to see the share price under $25 per share. It's getting close. I was buying this at $14 or $15 per share during the March 2020 decline. And to be honest, I really should have bought more. Dave & Buster's was never worth $14 or $15 per share. I really should have bought much more and just rolled that up to $50. And then an iconic Canadian luxury brand, Canada Goose. This is a name that I haven't talked about on this channel. And it's trading at less than 70% of what I believe its perpetual intrinsic value is. And the brand Canada Goose is not going anywhere. So once we come out of this consumer-led recession and we go back into sort of like a normalized economy, I do believe that this name will come back. And so the other thing that I do want to point out is that I have it highlighted below here. Every single name on this tracker has a full detailed model supporting the valuation, going from the top line revenue, working all the way down to that EPS, and then forecasting it out using a discounted cash flow. And so in order to get access to all of that, you can get access to all of those models at the lower tier of the Patreon. And if you want access to this epic live presentation that we have on a Zoom call with all of the Patreons every month, which is where I reserve my best work for, you can get access to that at the higher tier for the Patreons. Now, one of the things that I found very interesting is of the names that I just covered for you, Meta is among that list. And what's interesting about Meta is that I do believe that Meta is Michael Burry's stagflation-proof stock. And I actually talked about that in detail, and you can get to that video right here.